Hi, this is Umar. One of the most popular option strategies among traders, particularly retail traders, are short strangle. So what is short strangle? When you sell a out of the money call and out of the money put, it is a short strangle. Now by doing this, you hope the market to be range bound. That is, you expect the market to expire between the two sold options so that the option expires worthlessly and we keep the entire premium. But the markets are likely to expire between the range is less. What will happen is when the market moves violently on either side and touches your break-even point, you will start losing money. Though short strangle is easy to deploy, it is one of the riskiest strategies in option trading. What if the market gaps up or gaps down? You will be at big loss. Now lot of you ask for adjustment for short strangle, but the reality is it is very hard for retail traders to adjust short strangle and exit the trade profitably. Since the new margin rules, you will require lots and lots of funds to adjust to make adjustments. However, I will explain an adjustment strategy that will help you exit with a small profit or small loss. Now these adjustments are done after lots of research and backtesting which are not available in the public domain. Do watch the video till end so that you understand clearly how this strategy works. In this video we will see how to deploy a short strangle, make adjustment, and we will backtest the strategy so that you get a clear understanding on how this strategy works. Also consider subscribing to this channel as your support motivates us. Now, as I told, we will backtest this strategy. So the main objective of this video is we will deploy a strangle and we will adjust if thing goes wrong. So for this purpose, I have selected the Nifty February expiry. So why February expiry is because on February Nifty was very volatile. It was like trading in the range of around 1700 points. That is a good amount of volatility. So what we are going to do is we are going to backtest this strategy on the month of February. On the month of February, 1st of February, Nifty spot was around 13,700. So why I have selected February expiry? There is another good reason also, because before on the last of Jan, that is on the last week of Jan, volatility was very high. Why volatility was very high? Because this budget was due on next day. Whenever there is a event, binary event like financial budget or election, volatility will be very high. So we have selected February series for this trade, and we initiated this trade before on the last day of January series. Like we initiated this trade on January 29th, and you can see here volatility was very high on February 2nd, because on that day finance ministry was delivering their financial budget in the parliament. Volatility was very high. Implied volatility was around 23%, and immediately after the financial budget was delivered, volatility dropped to around 21%. From 23% it has dropped to 21%. So that is a significant drop, and the reason for doing this selling when the volatility is high is the premium will be very high. So when you sell a call or put when the volatility is high, and when the volatility goes down, you get to enjoy a good profit. So you can make this trade in favor of you when you sell a call or when you sell an option when the volatility is high. So back to the point, now Nifty spot on 1st of February was around 13,700. What I am going to do is I am going to sell a call and a put 400 points away. So why 400 point away is because whenever there was a big gap down, Nifty has maximum gap down was around 400 points. For example, on 2008 when Lehman Brothers collapsed, Nifty gapped down around 400 points. So that would be our ideal selling point. So Nifty on 1st of February is 13,700, and what I'm going to do is I'm going to sell a 14,100 call. Yeah, one lot. And on the downside I'm going to sell 13,300 put one lot. Yeah, so that makes a perfect strangle. So we have collected a total of 29,163. So our break even point on the downside is 13,000, and on the upside is 14,500. Unless until market is range bound and expires in between this range, we don't have any problem and we can enjoy the profit. But it is that less likely that Nifty is going to expire between this range, particularly when the volatility is India VIX is very high. Nowadays India VIX is around 20%, more than 20% every time. So I think that is going to be the new normal for India VIX. So as we have initiated this trade, we will see what happens on the next day. So the thumb rule is you have to adjust the trade once the out of the money call or out of the money put you have sold is at the money. So in this example, either 14,100 should be touched or 13,300 should be touched. If it goes up, it has to touch 14,100, and if it goes down, it has to touch 13,300. Why? Because once it is in the money, the delta is going to increase exponentially and your call is going to make a big loss. I'll explain you why shortly. See, now 14,100 is touched. We have sold a 14,100 call for 197. So it is already touched. You can still wait till it has breached the break-even point, but the problem here is once it is in the money, the delta is going to increase exponentially and your trade is going to make a big profit. Now what you have to do is, since it has touched our 14,100 strike has is at the money, what you will have to do is you have to sell a 14,050 call. You have to buy a 14,050 call, sorry, yeah, you have to buy a 14,050 call, one lot. So once you do it, what will happen is the upside is capped. No matter where the market goes up or it skyrockets, no problem, you don't have any problem. The only problem you have in this thing is the downside. So downside is not capped. Still you have to adjust if the market is coming back or reversing or trend is reversed. In this case, market is going up. Market was bullish on 1st of February. After that, on 2nd of February, actually market gapped up. You are going to see that in few minutes. Let me show you. Yeah. See, market has from 14,100 on 2nd of February, market has gapped up and it is gone to 14,600. We'll continue with this trade and see what has happened, what happens. Yeah, market is super bullish and it continues on the upside, upward trajectory. Yeah, see, now already you are in 3,500 profit. Had you not initiated this trade, you would have been in a loss of more than around around 45,000. Since you have bought this call, this loss is being compensated by this call what you have bought earlier. So this is how we adjust short strangle. And one more thing you can do here is, since market has traveled, market has gone so high, what you can do is you can book profit in the 13,300 put which we sold earlier. So this is the original put. We sold 14,100 call and 13,100 put on the 1st of February. Since market has traveled so far, market has was on bullish mode and market has significantly moved on the upside. What we can do is we can book profit on the 13,300 put we sold. So 13,300 put we sold for 190, I believe, is around two digit, only 22 rupees now. So what we can do is we can book profit on that. So I am booking profit on this. Yeah, once I book profit, no matter where the market goes, you are going to be in profit. Even if the market comes down and crashes, also you will be in profit. Not big profit, but a minor profit. So since I have sold this 13,300 put, what I am going to do is, market is around 15,000. I am going to sell another put. So always remember, you have to sell 400 points away. So I'm going to sell 14,600 put, yeah, one lot. So let's see what happens. Yeah, so this is how the market is going to be, and the maximum profit I'm going to enjoy if the market stays here or goes up is going to be 16,500. So I'm continuing with this trade and let's see what happens. Yeah, see, now on 16th of February, both the calls, sorry, uh, 3 trades out of 4 is on profit. The original call 14,100 you sold is in loss, but that is compensated by 14,050 call. And we have already booked a profit in 13,300 put. We have booked a profit of around 12,700. So again, after booking profit, we sold another put. We sold 14,600 put, that is also in good profit. So this should be the ideal time to exit this trade. Now 14,000 is somewhat of a good profit for a margin of around 2 lakhs, I believe. Yeah, or not even 2 lakhs, around 1.5 lakhs. But we will continue and we'll see where this trade takes us. Market has slided slightly. See, after we have initiated the trade, after we have made the adjustment, our break-even point is now on the downside is 14,400. You would have been in big loss if market has reversed or trend has changed. But still, we will continue. We'll see what is going to happen because there is only 2 trading sessions left. Yeah, on 25th of February, what happened is we have closed this trade with a profit of around 15,700. So this is how we adjust a strangle. But the point here is, what I want to tell you is that this strategy or this adjustment works only on one way movement. If Nifty makes 2-way or 3-way move, you will have to aggressively adjust your positions, which obviously will require lots and lots of margin money. So for one way move, this adjustment will work perfectly. If the market moves two-way or three-way, you will have to make adjustments aggressively. So I think this this strategy will help you in one way or another. Yeah, so that's the strategy. Since COVID, we can see markets are highly volatile. India VIX is almost about 20% all the time. Now that's a new normal. In this type of situation, strangles can be best option strategy to deploy, but the point is you will require lots of margin and skills to make adjustment. Now I hope you would have understood how this adjustment works. We have started a Telegram channel. Consider joining the Telegram channel for market updates and trades we execute and market insight. Link for the same is on the description below. Hope you enjoyed this video and thanks for watching.